remember to register in the class. Okay. And please, if you have issues, write me an email to register into this class. Okay. Okay. This week we start with the reformulation of the financial statements. Today we focus on the reformulation of the balance sheet, and tomorrow we have the two classes at 8:45 and 11 for the two groups, group 1 and group 2. I hope that you are already assigned to these two groups. And tomorrow we will apply the reformulation of the balance sheet to the FILA case. I have uploaded different files for the FILA case, and we will go through the files and through the financial statements, the press releases, and the Excel file. But today I explain the theory behind the reformulation of the balance sheet. The formulation of the balance sheet that we are going to approach is called managerial balance sheet or strategic balance sheet. In Italian is stato patrimoniale funzionale. It's not the financial balance sheet, lo stato patrimoniale finanziario, the one that you probably know. It is a different reformulation, and this is the reformulation used by the financial analysts and in almost the majority of companies. The starting point is the question that we have. And the question that we have is how to assess the profitability of the business of the company. And to assess the profitability of a business, we should know the amount of resources that the company has invested in the business and the return from these investments. These are the two main questions. And another important question that we want to deal with is the origin of the funds that the company is using to finance the investment. So the shareholders and the debt holders. Okay? And with this approach, we try to isolate three different areas of activities of a company. The first area is the financing activity. The second area is the investing activity. And the third area is the operational activity. So financing, investing, and operating. If we want to analyze these three areas, we have to represent the data in the financial statement according to these three different areas. So we should identify the financing area, the investing area, and the operating area. And this approach is very simple, it's very easy, because it goes back to the way through which a company exists. When we start a company, when an entrepreneur starts a company, the first point is that this entrepreneur has a business idea. And the first question that she has, is how to transform this business idea into a business. This idea into a business. The first point is, how can I get the money? So, how can I find the financial resources to transform this idea into a business? So the first set of decisions is a set of decisions regarding the financing of the company. Okay? And when an entrepreneur is facing this financing decision, he has mainly two different sources to collect the funds. One is from the shareholders, and the other is from the debt holders. So the first part is how to get the money, financing decisions, debt holders and shareholders. So we want to have a section of the balance sheet in which we are able to isolate the financing decisions. So the amount of money provided by the debt holders and the amount of money provided by the shareholders. So when we refer to the financing part of the balance sheet, we refer to the debt holders and the shareholders. For us, these are not for us, for the financial community, for us a financial community, the debts are the debts with providers of financial resources. So, when we have a supplier, okay, un fornitore, this for us is not a debt, is a liability. A debt is when our counterpart is a bank, is a financial institution, or is a private investor. An investor that has subscribed a bond issued by the company. Okay? These are our financial debt. Okay? That are different from the liability is different from the accounts payable. Because an accounts payable does not depend on a financial decision. It is the consequence of the operating activity of a company. But we will go back later on this one. So the first set of decisions is about how to finance the company. Oh, please, if you have questions, please ask. Raise your hand and ask. Okay? Also in Italian, if you are not comfortable with English, I'm not able to speak other languages, French, Chinese, or German, etc. But please, if you have questions, ask also in German. I try to figure out how to answer. I'm not sure that the answer will be the answer of your question, but it will be an answer, okay? But please, don't shy and make questions, okay? So the first set, invest. Now we are in a situation in which we have raised the money. We needed 1.5 million euro to start the business. Now we have 1 million euro from our shareholders and €500,000 euro from the debt holders. And now we have 1.5 million cash. So our balance sheet, on the left side we had cash 1.5 million, And on the other side, we have debt 0.5 million and equity 1 million. Okay? This is our financial situation. But we started this company to run a business. So the next step is to invest the money to start the business. So the second level of decisions is composed by investing activity. So we have raised money, and now we invest money. So we transform this 1.5 million cash into assets. We buy a software, we buy machineries, we buy raw materials, we buy all, we hire people. So we essentially invest this money in our core business. So now we have financial resources, the financial activity, and we have invested these financial resources. We do not have any more cash on the left. We still have some cash, but we have assets, raw materials, we have machineries, etc., etc. All the assets that we need for running the business. Financing, then investing. Okay? Now we have our asset base. We have also our people, etc., etc. And now we start running the business. How? Using these assets for producing the goods, for offering the services. And now we have costs and revenues, operating activity. Okay? As a consequence, we have to re-elaborate this. We have to re-elaborate our balance sheet, stato patrimoniale, where on one side all financial resources, the financial providers of resources, and on the other side all investing activities, or better, all the activities related to the core business. And on the one side, we can have all financial assets and liabilities, because we have the financial, we want to have separately the financial side. And on the other part of the balance sheet, we have all assets and liabilities related to the operating activity, the investing. So we have two different sides. No more assets versus liabilities and equity, but the financial resources at large and the operating resources at large. This is the result that we are looking for. We want to reformulate the balance sheet to obtain this structure. And if we look at a balance sheet of a company, this is the balance sheet, this is the annual report of F.I.L.A. And, okay. You see that according to financial accounting standard, the international accounting standard, the presentation format of the financial statement is assets versus liabilities. And in the asset side, we have assets that really refer to the business, intangible asset, property, plant, equipment, biological asset, non-current financial asset, equity accounting liabilities. We will indicate tomorrow on the meaning of each item. And these assets are non-current. You remember that according to the International Accounting Standard, assets are divided between current and non-current. And in the part that I asked you to prepare for today's class. And then we have current assets. We have financial assets, current tax assets, inventories, trade receivables and other assets, and cash equivalents. Is it clear? It should be clear that some assets relate to the core business, also in the current asset. And for example, inventories relate to the core business. Trade receivable and other assets relate to the core business. But we have assets that do not relate to the core business because they are the result of the financing decision. So for example, current financial asset. Let me go back to the example. We have raised 1.5 million euro, and we have invested 1.4 million euro. We still have 0.1 million euro available. This is a current asset. This is cash. Is this an investment in the core business? Is it an operating investment? No, it isn't. Because it is the cash that we still have available. Okay? And it depends on the financial decision. Because if we would have raised 1.4 million, we have 1.4 million of raised capital and 1.4 million of investment. But in this case, we have 1.5 million of raised capital and 1.5 million investment. No, we have 1.4 million of investment and 1.4 million of raised capital. And this 1.4 million of raised capital is the amount of our debt plus the equity minus the amount of cash that we still have. So cash is not an operating investment. It's the result of a financial decision. Okay? The consequence is that we are not happy with this structure because this structure does not permit us to isolate the financial decision from the operating investment. Okay? The total asset does not represent the investment of the company. They are the asset of the company that are different from the investment of it. Yeah?
And then in current financial assets, that's what you're saying, we are including the 1.5 million completely, including that.
At the beginning. At the beginning, when we raise the money, do remember that we have two different sections. One is the financing section, and in that case, we still have 1.5. The amount of money raised. Okay? On the other side, it depends if we have already invested, used this money, or if they are still available. If we have used all the money, we have 1.5 million financing, 1.5 million investment. But if we don't, if we have used less than 1.5 million, the amount of money invested is not 1.5 million. And our debts are not 1.5 million because we have still cash. So the net debt that we have is 1.5 million minus the cash that we still have in hand. Okay? And so this is why we want to isolate the net debt. We are not interested in the total debt, but we are interested in the net debt. I will go back to this point to clarify better later. Okay? But the point is that we are not happy with this structure. And the same is for the liability side. Because some of these items here, of the non-current liabilities and current liabilities, are not debts that derive from a financial decision. Because some of these liabilities depends on the business, on the core business, on the decision that we made for the core business. For example, credit payables and other liabilities. Are they a financing decision? No, because the counterpart is not the bank. The counterpart is the supplier. And the supplier is not a financial institution. It's something that is about the business relationship between the company and the suppliers. Also, tax liability is not a financing decision. It is the result of the relationship between the company and the Internal Revenue Service. The same for the employee benefits. So again, this structure, through this structure, we are not able to separate financial decision from investments. This structure only identifies current assets and liabilities versus non-current assets and liabilities. So when we reformulate the financial statements, we want to consider the two different perspectives. The time perspective, current versus non-current, and the financial versus investing/operating. So we start from our balance sheet, in which we have current and non-current assets and liabilities. And this is the structure that we have from the International Accounting Standard. The structure that I have shown you regarding the FILA balance sheet. We want to add to this structure the other dimension of operating, so a dimension related to the core business, how to run the core business, and a dimension related to how to finance the core business. So we add to this dimension the operating/financing dimension. So we have operating and financing. when we classify the balance sheet, we have to put together these two dimensions. The balance sheet that we have according to the International Accounting Standard put these two dimensions together because we have operating assets with in the same category of financial assets. We have operating liabilities in the same category of financial liabilities. We want to separate these two categories. Okay? On the left, we have all the operating assets and liabilities, and on the right, we have all the financial assets and liabilities. So when we approach the reformulation of a balance sheet, we should go item by item, understanding the meaning of the transactions that are behind the item, and classify the item accordingly. It means that if we have a short-term asset, and this asset is operating, it goes on the top left in the cell number 1. So, some examples, please could you give me some examples of operating short-term assets? So, assets that are classified current, that relate to the core business.
Receivable.
Inventory is one of them.
Raw material.
Other examples? Raw materials are part of the inventory. So we have inventories, raw materials, work in progress, finished goods, account receivables, other examples. These are the two more typical. Other examples, please?
Prepaid expenses.
Prepaid expenses. This is a good point. All prepaid expenses can be considered operational, or could we have some prepaid expenses that are not operational? Because for account receivable inventory, it is clear that they are operational. For prepaid expenses, if we prepay the interest for the next 3 years regarding a loan. Okay, we pay all the interest now. Is this a prepaid expense, right? Is part is current and part is non-current. For the interest of the next year is current, for the interest of the year T+2 is non-current. Can we consider this item as an operating item? No, it is a financial item. So, for prepaid expenses and for other categories of prepaid, of other categories of cost, we should consider if these relate to the operating activity or not. Other examples are tax credit. This is for current. When we see different financial statements, different annual reports, we can find a very long list of specific items that might be considered as operating. And continuing with the asset side. Non-current operating assets. Some examples.
Machinery.
Machinery. Sorry? PPE, property, plant, and equipment. Intangible assets. So we have brand, trademarks, etc., etc. Yeah.
Goodwill.
Goodwill. We can have other different types of these items, but these are the main types. And if I say equity investment in other companies, what do you think? Equity investments in other companies. So they are part of minority shareholding in other companies. Minority, but otherwise they enter into the consolidated financial statements, and this is another case. But minority investments in other companies. So equity investments as a minority stake in another company. Do we consider this investment as operating or financial? Yes. It depends on the core business of the company. And could you explain better, please? I raise the hand and say, we are not talking about financial companies here. We are talking about service, industrial companies, because financial companies, they follow a different regulation, okay? So banks, private equity, etc., they have a different structure of the financial statements. And so you are right, but this is something that is outside our perimeter, okay? But your name is? Stefano is going in the right direction. If you are not a private equity company, could you elaborate more on this?
Yeah, I think that on the very side, because on the financial side, because it is not about people business.
So Stefano is telling, if we have a shareholding, a minority shareholding in another company, and we are an industrial service company, it does not go into the operating side because it is a financial investment. So, do you agree with Stefano, or you want to add something? Your name? Francesco?
I'd say that the minority of the other company is related to my core business, it's operating, instead of on the other side, it's financial.
Stefano? Francesco is introducing another point. And Francesco says, technically speaking, I work on what you are saying. Technically speaking, if we remain to the formal technical investment, we say, yes, it is a financial investment because we have not bought goods, we have not bought services, but we have bought a financial shareholder. So we have made a financial investment. But Francesco is adding something. He says, yes, but this investment is related to a core business. So, for example, we have bought the 22% of a company that is even involved in the research and development. Or we have bought a minority shareholding of a company that owns retail stores in Europe. And we want to use these retail stores as a venue where to sell our products. Technically speaking, this is a financial investment. But this is related to the core business. So I would say, not I, but usually, we classify this investment as an operating investment because it relates to the core business. Okay? Even if it is a financial instrument. Okay? Or so equity investment is operating. We have also a case in which what seems an operating investment is, on the contrary, a financial investment. So something that seems operating, that is a financial decision. Any idea? Yes?
Maybe leasing.
Leasing is a financial decision that is considered operating. Is like this. I would say something that is operating that is considered financing. Okay? Yes?
CapEx, capital expenditure.
Capital expenditure, but depends on what you are buying.
Maintenance CapEx.
They are operating because with the maintenance capex do not go into the financial in the balance sheet. They go directly into the income statement. The maintenance. If we are increasing the amount of the production capacity, these are investing, but is like we buy a new machinery, right? And if we buy a new machinery, it is clearly an operating activity. So capex, capital expenditures, they are operating. Yes?
Is it cash?
Cash is financing.
Okay. Yeah. Okay. But you said, but you said operating considered as financing.
Yeah. I agree with your name, please.
Thomas.
With Thomas, because there is a lot of discussion if cash should be considered as financing or operating. Because what we can think is that, we get cash from our core business. Okay, so cash is considered operating. Technically speaking, cash is, for the 99% of financial analysts, considered as financial. Your name?
Oliver, excess
Oliver.
cash.
this is a point that I would say one of the next classes, because we classify operating cash and excess cash. The operating cash is operating, the excess cash is financing. But in that case, it's very difficult to estimate the excess cash. There are some econometric models that want to estimate the excess cash to identify what Thomas is saying, that part of cash is operating and part of cash can be considered financial. But usually, when you look at the financial statements reformulated by a financial analyst, you find that cash is ever financial. My example, and what I was thinking is the following. We are a retail company, and we have some contracts with franchisees. So it means that we don't have our own stores, but we open the stores using the franchisee contracts. And we sell to them the goods, but we also sell services. We could also sell the furniture, because the shops that should have the same layout because of the brand, etc. So one of the examples is Benetton. A majority, now a percentage of, not more than majority, of the shops are not owned directly from Benetton, from the company. They are owned by the franchisee. But if you go to a shop, you see that the layout is the same. And the franchisee must buy from the company the goods, obviously, but also the furniture, etc. Usually, the terms of payment for the goods are 60 days. Okay? But now, these retail companies, or starting from July, August, the retail companies, these shops, have bought all the clothes for the winter season, right? And if you are a startup, I can say, okay, I give you the goods, the clothes, the t-shirt, etc., the pullover, etc., etc. But you pay me next March, not in 60 days, but in 210 days, in 7 months. Okay? This is a trade receivable, right? Because we have sold finished goods. Can we consider this as an operating asset, or it is a financial asset? Because it is clear, at least for me, that if the terms of payments are 60 days, is absolutely 100% clear that the trade receivable is operating. But if it is 7 months, the remaining 5 months are operating or financial? Probably we are financing them. And so this is an example of what we think as clearly an operating asset. Is it, on the contrary, a financial asset? because we are financing them, postponing the terms of payment. Well beyond the usual terms of payment in the business. Thomas, you raised your hand.
No, I thought it's about like the proportion and like the 12-month period if it's like non-current or current.
Okay, but we are still inside the year, right? But again, if it is longer than 1 year, we have own part of to classify part of them as non-current. But my point is not if they are current or not current. My point is that should be considered as financial, even if technically speaking they are an operating asset. Okay? What is the message behind this? The message is that when we classify the financial statement, then we have we can go to other examples, but we will see the example working on the real. We should not consider only the item, the title of the item. Because sometimes in the note, we find the information that this asset is financing, even if it seems operating, or it is operating even if it seems financing. The example of this part of trade receivable, the example is part of the equity investment. We can do the same for all our liabilities. We go through the balance sheet and we look at the liability side of the balance sheet, identify which liabilities refer to the operating activity, to the core business of it. Okay? So, some examples, please. Could you give me some suggestions regarding liabilities that are considered, can be considered as operating?
Period, up to the period like.
Some items here that can be considered operating. Employee benefits. Yeah, deferred tax. Deferred tax. Provisions for risk and charges. Yeah.
Non-payables.
Trade payables. Okay? Again, we have identified these items. Usually in the financial statements, in the annual report, you find close to each item a note. So we go to note 13 to understand what is non-current financial liabilities. Okay? To note 14, employee benefits, to explain what is inside the employee benefits. Because, for example, if we have equity investments, and we have equity investment, or we go for financial, if we look at the notes, and we discover that equity investments relate to the core business, we could classify this equity investment on part of it into the operating side. Okay. So now, we are considering this matrix as the credit and debt side of a balance sheet. So we have all the assets on the left side, and we move from the right side of the balance sheet into the left side of the balance sheet, our liabilities. If we move from the credit to the debt side, we have to change the sign, right? It means that as operating current, where these are assets, so we have operating short-term assets, but we have also operating short-term liabilities. And operating short-term liabilities, we have trade, receivables, and they are with a minus. We have current tax liabilities with a minus. We have employee benefit with a minus. Because we move from the debt side to the credit side. Okay? And the same is for non-current assets. We have non-current operating liabilities. Provision for risk and charges, trade payment, trade receivable, long term, etc. Okay? So, there are liabilities for trade receivables or trade payables. Okay, so this is, yes?
One question, how do we deal with depreciation?
Is it part of the balance sheet?
Not to it. Well, it's fun for us every company.
Is the accumulated depreciation. So the accumulated depreciation is part of the non-current asset, because the non-current asset are the gross value and the net value, and the difference is the accumulated depreciation. Okay? Okay. 10 minutes break. And then start with the other part of the
Qu'est-ce qu'il y a? Je pense que j'en profite pour aller à l'autre en fait, comme je lui ai dit.
Ah bah ouais.
That was like,